Welcome back to MarketSnap, your daily rundown of the market's biggest moves. Today was a session that had a little bit of everything. A massive single stock move, a bond market intervention that didn't quite stick, and a clear signal from the consumer that's worth paying attention to. Let's just say the risk-on mood from yesterday didn't carry over. We saw a broad sell-off, but the real story is what's happening beneath the surface. We're going to unpack the Treasury's big move, why the market's biggest retailer just got hammered, and the surprising pockets of strength that are flying under the radar. Let's get right to the scoreboard. It was a rough day for the major averages, with the Dow leading the decline, shedding over 700 points. The S&P 500 gave back about 0.9%, and the Nasdaq wasn't far behind, down a full percent. The Russell 2000 also got hit, falling 1.3%, showing this weakness wasn't just confined to the megacaps. The VIX, our fear gauge, spiked over 7% to close above 16, telling you that traders are starting to feel a little uneasy. The S&P 500 slide puts it back below that key 17,700 level, a reminder that we're still stuck in this range-bound battle. The index is trying to digest a lot of conflicting signals, strong earnings, but also rising rates and geopolitical tension. The Nasdaq is feeling the pressure from the tech sector, which has been the engine of this bull market. With yields climbing, high multiple growth stocks are naturally going to feel some heat, and that's exactly what we saw today. But the real action today wasn't in the stock market, it was in the bond market. Treasury Secretary Scott Bessent is essentially trying to put a floor under long-term bond prices by expanding the government's buyback program. He's calling it a big toolkit, and he's hinted there's more to come. The market's initial reaction was positive, but that enthusiasm faded fast. The move is being seen by many as treating a symptom, not the cause. The cause? A $40 trillion debt pile, and a government that's spending more than it's taking in. That's a fundamental issue that a buyback program, however large, can't easily fix. And speaking of things that can't be fixed by a quick fix, let's talk about Walmart. The retail giant posted earnings that actually beat expectations, but same-store sales growth came in at its weakest pace in 6 years. That was a shock to the system, and the stock got crushed, falling over 9%. This is a massive signal. When Walmart, the king of value, tells you the American consumer is pulling back, you have to listen. It's a stark reminder that the health of the economy starts with the consumer, and the consumer is feeling the pinch. But while the consumer is struggling, the memory chip cycle is absolutely booming. SK Hynix surged over 4% on a record buyback, and Micron followed suit, gaining nearly 4%. This is a sector that's being driven by the insatiable demand for AI infrastructure. It's a great example of how the market is bifurcated right now. You have traditional parts of the economy slowing down, while the AI-driven parts are firing on all cylinders. We also saw Deere & Company jump nearly 7% after raising its full-year profit outlook, showing that the industrial side of the economy has some legs too. If we look at the heavy hitters, it was a sea of red. Apple, Amazon, and Tesla all finished lower, dragged down by the broader market sentiment. Even Nvidia, the AI poster child, couldn't escape the selling pressure, though it was only down fractionally. The one standout in the mega-cap space was Marvell Technology, which jumped over 5% on the back of a massive new deal with Alphabet. This is a reminder that in this market, it's all about the specific catalysts, not just the macro backdrop. Zooming out to the weekly performance, we see a clear theme emerging. Safety and hard assets are in vogue. Gold miners are having a phenomenal week, with names like AngloGold Ashanti and Wheaton Precious Metals up double digits. This is a classic flight to safety trade, driven by geopolitical uncertainty and concerns about the dollar. On the flip side, the AI trade is taking a breather. Names like CoreWeave and Broadcom are down over 10% for the week, showing that even the hottest sectors are vulnerable to profit-taking and valuation concerns. That weekly view really crystallizes the tug-of-war we're in. You have money rotating out of high-flying tech and into more defensive, tangible assets. It's a risk-off signal that's worth monitoring, especially if bond yields continue to climb. Looking at the sector action for the week, it's a clear picture. Basic materials and healthcare are leading the way, both up over 2.5% for the week. These are classic defensive and inflation hedge plays. On the flip side, technology is the clear laggard, down nearly 4% on the week. This is a significant rotation, and it's telling you that investors are getting more cautious about paying up for growth in an environment of rising rates. The dispersion between the best and worst performing sectors is a story in itself. When you see money flowing out of tech and into materials, it's a sign that the market is bracing for a potential slowdown or at least a period of higher volatility. It's not a panic, but it's a clear shift in sentiment. As we look ahead, the earnings calendar is starting to wind down, but there are still a few key names on deck. We're watching Ross Stores, which reports after the close, and Intuit, which is set to report later this week. These consumer-facing names will give us another read on the health of the American shopper, especially after Walmart's warning shot. We're also keeping an eye on Workday and Analog Devices, which will provide more color on the enterprise and semiconductor spaces. You can find exclusive earnings transcript summaries on MarketSnap to get deeper insights into these reports. Beyond the earnings, there are a few other big-picture items to keep on your radar. The geopolitical situation with Iran is escalating, with President Trump threatening economic D-Day. This is keeping oil prices elevated, with Brent crude trading around $93 a barrel. That's a tax on the consumer and a potential source of inflation. Also, the Fed minutes released yesterday showed a growing unease about inflation, with some officials even open to the idea of rate hikes. That's a hawkish signal that's contributing to the higher yield environment. That's a wrap for today's stock market summary from MarketSnap. Thanks for tuning in. Today was a clear reminder that the market is navigating a complex web of crosscurrents, a resilient AI trade, a cautious consumer, and a bond market that's demanding answers. Stay tuned for more daily recaps and in-depth SWOT analyses to help you navigate these choppy waters. We'll see you back here tomorrow.